Welcome to the deep dive. Today, we're going to kind of strap on our thinking caps and dive into the world of corporate takeovers, specifically during the high-stakes 1980s. We've got a real gem for you, a 1988 research paper by Michael Jensen, a titan in the world of finance. It's called Takeovers, Their Causes and Consequences, and it was published in the Journal of Economic Perspectives. Buckle up, because we're about to unpack Jensen's theories, explore the real-world examples that brought them to life, and see how they still resonate in today's corporate landscape.
It's a fascinating deep dive, especially for anyone who wants to understand the forces shaping the business world and, let's face it, their own investment portfolio.
Right. Jensen paints this picture of the 1980s as a takeover frenzy. He throws out this incredible stat. A record $180 billion per year was spent on mergers and acquisitions in 1985 and 1986 alone. But here's the twist. He argues that this wasn't corporate chaos. It was actually creating value. Shareholders of companies being acquired saw gains totaling $346 billion in the decade leading up to 1986. That's a whole lot of money changing hands.
What's interesting is that Jensen argues this boom wasn't just about greed, it was a corrective force. He claims takeovers push companies to become more efficient, forcing them to figure out where resources are truly most valuable. It's like a pressure test for the entire corporate ecosystem.
So survival of the fittest, but in a financial sense.
Exactly. Now, Jensen's big idea, the one that really made waves, is his free cash flow theory. Imagine a company sitting on a pile of cash after funding all of its worthwhile projects. That's free cash flow. Jensen's theory is that this extra cash often creates a power struggle between managers and shareholders.
Okay, I can see how that could lead to tension. Who gets to decide what to do with all that money?
That's the crux of the problem. Managers, according to Jensen, love to reinvest free cash flow. They want to expand, launch new projects, even if those projects offer low returns. It's the classic empire-building mentality.
Bigger company, bigger office, bigger bonuses, right. But wait, don't shareholders ultimately control the company?
In theory, yes. But Jensen argues there's a disconnect. Shareholders, he says, would rather see that cash come back to them in the form of dividends. They want a return on their investment, not promises of some future uncertain growth.
So it's a classic clash of priorities, growth versus returns. What's Jensen's solution to this financial tug-of-war?
His answer might surprise you. Debt. Jensen argues that debt can actually be a powerful tool to force companies to become more efficient and, crucially, return that cash to shareholders.
Hold on, debt. Isn't that usually seen as a bad thing, especially for companies?
Not necessarily. Debt creates financial obligations, like mandatory payments to creditors. This pressure cooker environment forces companies to focus on profitability and cut out wasteful spending. It's like a financial boot camp.
So instead of managers having free rein to spend that extra cash, they're forced to make tough choices and prioritize returns.
Interesting. Can you give me a real-world example of this debt-driven efficiency in action? Think back to the infamous RJR Nabisco buyout in the late 1980s. Orchestrated by the private equity firm KKR. They loaded up the company with debt, forcing a dramatic restructuring and a laser focus on generating cash. That's Jensen's theory in action, albeit on a massive scale.
I remember that story. It's a huge deal. So debt as a disciplinarian, that's a new way to look at it. Now, to really bring his free cash flow theory to life, Jensen uses the oil industry of the 1980s as a prime example. Why oil specifically?
The 1980s were a turbulent time for oil. Demand was falling, but prices were still high, so these companies were swimming in cash. The problem was they had limited opportunities for profitable growth within their industry.
So they were flush with cash. But there weren't enough good projects to invest in. The classic setup for a free cash flow showdown, right?
Exactly. Jensen argues that many oil company managers, instead of returning that cash to shareholders, kept spending it on exploration and development. Even though returns were low, they were clinging to their empires, even as the market shifted beneath them.
Sounds like they were doubling down on a losing hand. Were they completely ignoring their shareholders' interests?
Jensen suggests that was a major factor, and as you might imagine, this created a prime target for corporate raiders. These investors saw a chance to step in, shake things up, and force the oil industry to become more efficient.
And they were probably motivated by the potential for huge payouts.
Yeah.
To shareholders, if they could successfully restructure these companies right.
Of course. They saw an opportunity to unlock value that was being squandered by management. And in the process, these takeovers led to significant payouts to shareholders, reduced wasteful spending, and ultimately a more streamlined and efficient oil industry.
So Jensen's free cash flow theory played out in a very dramatic way in the oil industry. But is this just an oil industry phenomenon?
Well, not at all. Jensen points to tobacco broadcasting and food industries as other examples, where companies were generating lots of cash, but had limited growth opportunities, making them ripe for takeovers or leveraged buyouts. Essentially, any industry where companies are sitting on a pile of cash, but struggling to find profitable investments, is a potential target.
So it sounds like this free cash flow problem
Yeah.
and the resulting takeover activity is really a symptom of a bigger issue, the potential for conflict between managers and shareholders.
Exactly. And Jensen sees the market for corporate control, driven by this free cash flow dynamic, as a crucial mechanism for keeping that conflict in check. It forces companies to be more efficient, more accountable to their shareholders, and ultimately more aligned with the interests of the market.
That's a pretty compelling argument. But doesn't this constant threat of takeovers create a climate of fear in the corporate world?
It certainly raises the stakes, and one of the big criticisms of this takeover frenzy is that it forces managers to focus on short-term profits, even if it means sacrificing long-term growth.
So it's like a trade-off. Short-term gains for shareholders versus potentially sacrificing the company's future. That's a tough dilemma for managers to face. What does Jensen say about that?
He tackles this head-on. Jensen argues that the market isn't short-sighted. It can actually see through short-term maneuvers. He points out that companies with high price-to-earnings ratios are being valued for their future growth potential, not just their current earnings.
Wait, so he's saying the market actually rewards companies for making smart long-term investments? That seems counterintuitive, given all this talk about short-term pressures.
That's exactly his point. He argues that much of the so-called short-termism is actually due to managers making poor long-term decisions, which the market then punishes them for.
I see. So he's flipping the script. It's not that takeovers force companies to be short-sighted. It's that companies with poor long-term strategies are more likely to be taken over.
Precisely. Now let's get into some of the juicier, more controversial tactics used during takeovers. Things like golden parachutes and green mail.
Okay, golden parachutes. Those always sound so luxurious. Fill me in.
Essentially, they are severance packages given to top executives if a company is taken over. And we're not talking about a modest severance. These can be incredibly generous, multi-million-dollar deals.
So if a company gets taken over, the executives float down to safety with a big bag of cash, even if they were the ones who drove the company into the ground. That doesn't seem very fair to the employees or shareholders who might be losing out.
You can see why they're controversial. But Jensen offers a nuanced perspective on this. He argues that golden parachutes, when designed correctly, can actually reduce conflicts of interest between managers and shareholders during takeovers.
Hold on. How does giving executives a huge payout when they lose their jobs benefit shareholders? That's a tough sell.
Think of it this way. Shareholders are essentially asking managers to negotiate the sale of the company. And that sale might involve personal costs for those managers, including the loss of their jobs and reputations.
I suppose negotiating your own demise isn't exactly a motivating factor.
Exactly. Golden parachutes, in Jensen's view, act as a sort of insurance policy. They create a financial safety net for managers, which in theory allows them to act in the best interests of shareholders during those crucial negotiations, rather than trying to save their own careers at all costs.
So it's about aligning incentives. By taking their own financial security out of the equation, managers can focus on getting the best possible deal for shareholders, even if it means their own departure. Okay, I can see the logic there, but it still feels a bit icky.
It definitely raises questions about fairness and executive compensation, especially when compared to the rank-and-file employees who might be losing their jobs without a golden parachute to cushion the blow. But that's a whole other debate.
Right. Now what about green mail? That sounds a lot less glamorous and a lot more devious.
It can be. Green mail is essentially corporate extortion. A company buys back shares from a specific investor, often at a premium, to prevent them from launching a hostile takeover.
So it's like paying a bully to leave you alone. I bet shareholders aren't too happy about that.
You're right. Jensen sees green mail as harmful to shareholders because it allows managers to entrench themselves and avoid takeovers that might actually benefit the company and its owners.
It sounds like another case of managers putting their own interests ahead of the company's. Okay, we've covered a lot of ground. The takeover boom of the 1980s, Jensen's free cash flow theory, and some of the more colorful tactics used in this high-stakes game. Where do we go from here?
Well, next we'll delve into Jensen's specific recommendations for improving corporate governance and ensuring that the market for corporate control functions effectively, He doesn't just diagnose the problems, he offers some bold solutions as well.
Sounds like a good plan. Stay tuned, because we're about to get into the nitty-gritty of Jensen's prescriptions for a healthier corporate world. Welcome back to the Deep Dive. We're continuing our exploration of corporate takeovers, with Michael Jensen's groundbreaking work as our guide. Last time, we left off with the free cash flow problem and the potential for conflict between managers who want to build empires and shareholders who want to see returns. Now it's time to get into Jensen's solutions. He doesn't just identify the problems, he offers some pretty bold prescriptions for a healthier corporate world.
And some of his recommendations might surprise you. For example, one of his key strategies for aligning the interests of managers and shareholders is to encourage greater use of debt.
More debt. But earlier we talked about how debt can be a double-edged sword. On the one hand, it can force companies to be more efficient, like that RJR Nabisco example. But on the other hand, too much debt can make a company vulnerable. So how does Jensen reconcile those two perspectives?
It's about striking a balance. Jensen argues that debt, when used strategically, can act as a powerful tool to reduce what he calls agency costs, which are basically the losses that occur when managers don't act in the best interests of shareholders.
So by taking on more debt, companies can essentially tie their own hands and reduce the temptation for managers to waste shareholder money on pet projects or ill-advised expansions.
Exactly. It's like setting up a financial guardrail to keep managers from veering off course. Think of it like this. If a company has high debt payments to make each quarter, managers are less likely to squander cash on risky ventures or vanity projects.
That makes sense. The pressure to meet those debt obligations forces them to prioritize profitability and efficiency. But isn't there a risk that companies could over-leverage themselves and become financially unstable, especially if there's an economic downturn?
There's always that risk. But Jensen argues that the market acts as a disciplinarian. If a company takes on too much debt, investors will react negatively, driving down the stock price and potentially making the company a target for a takeover itself.
So it's a self-regulating system. Companies have an incentive to take on enough debt to discipline themselves, but not so much that they put themselves in jeopardy. It's a delicate balancing act.
Precisely. Now let's move on to another controversial issue that Jensen tackles: poison pills. These are strategies that companies use to make themselves less attractive to potential acquirers.
Right, we touched on this earlier. Things like issuing new shares that dilute the ownership of an acquirer, or creating special rights for existing shareholders that make a takeover more difficult, basically making themselves harder to swallow.
Exactly. And Jensen is not a fan of these defensive tactics. He believes they give too much power to managers to entrench themselves and prevent takeovers. That might actually benefit shareholders.
So he sees them as a way for managers to prioritize their own job security over the potential for increased shareholder value.
That's his main critique. And his solution is simple but radical: give shareholders more say in the matter. Jensen argues that decisions about whether to implement poison pills should be put to a shareholder vote.
So more shareholder democracy in the boardroom. That seems like a logical way to align interests. But would companies be willing to cede that much control to their shareholders?
That's the million-dollar question. Jensen believes that empowering shareholders in this way would make the market for corporate control more efficient and would ultimately benefit both companies and investors.
Now I want to circle back to another issue we discussed earlier, those 13D disclosure rules that require investors to publicly disclose their holdings and intentions after acquiring 5% of a company's shares.
Right. Those rules are designed to increase transparency, but Jensen argues that they actually have the unintended consequence of discouraging takeovers.
Because it tips off other investors and allows them to free ride on the acquirer's research and analysis, driving up the price and making the takeover less profitable.
Exactly. And he believes this ultimately reduces the pressure on companies to perform well and keeps inefficient management teams in place for longer than they should be.
So what's his solution? Does he want to get rid of these disclosure requirements altogether?
He's quite radical on this point. Jensen advocates for abolishing the 13D reporting requirement completely, or at the very least, significantly raising that 5% threshold to allow investors to build a more substantial position before having to tip their hand.
I can see how that would make it easier for investors to launch successful takeover bids. But wouldn't that also increase the risk of market manipulation and insider trading?
That's a valid concern, and one that Jensen acknowledges. But he argues that the benefits of a more active and dynamic market for corporate control outweigh those risks.
So he's essentially saying that a bit of risk is acceptable if it leads to a more efficient allocation of capital and better corporate governance overall.
That's a good summation of his position. Now, beyond these specific policy recommendations, Jensen also offers a broader perspective on the role of the market for corporate control in a well-functioning economy. He argues that this market is a crucial mechanism for ensuring that companies are well-managed, resources are allocated efficiently, and shareholders are ultimately rewarded for their investments.
It's like a constant pressure. That keeps companies on their toes and forces them to perform, both for their shareholders and for the broader economy.
Exactly. He sees it as an essential part of a healthy capitalist system, and he believes that any attempts to restrict this market, whether through regulation or legislation, will ultimately harm shareholders, reduce innovation, and make the economy less dynamic.
So it's a question of striking the right balance between regulation and market forces, a debate that continues to this day. Now I want to shift gears for a moment and talk about a trend that Jensen actually anticipated: the rise of institutional investors.
Ah, yes. Those giant investment funds that manage vast sums of money for pension funds, endowments, and other large investors.
Exactly. And Jensen recognized that these institutional investors have the potential to play a much more active role in corporate governance than individual investors.
Because they have the clout to really move the needle right. Their ownership stakes are often large enough to influence board appointments, executive compensation, and even major strategic decisions.
Exactly. They're not just passive bystanders. They have a vested interest in ensuring that companies are well run and maximizing shareholder value. And this is a trend that has only accelerated since Jensen wrote his paper.
Absolutely. Today, institutional investors are major players in the market for corporate control, often leading the charge for takeovers or pushing for changes in corporate strategy that can unlock shareholder value.
So Jensen's work foreshadowed this shift in the balance of power in the corporate world. It's amazing how prescient his analysis was. Now, before we wrap up this part of our deep dive, I want to revisit one of Jensen's core arguments, that the market is not myopic, that it can actually recognize and reward long-term value creation.
Yes, that's a key point, especially in today's environment, where there's so much pressure on companies to deliver short-term results.
Exactly. So let's break down Jensen's argument and see how it holds up in light of what we've seen in the decades since he wrote his paper.
Sounds good. One of his main points is that the market isn't just focused on the next quarter's earnings report. It's also looking at a company's long-term growth potential, its management team, its competitive position, and a whole host of other factors that contribute to sustainable value creation.
He points to companies with high price-to-earnings ratios as evidence for this. Those high valuations suggest that investors are betting on future growth, not just current profits.
Right. And he also cites evidence that stock prices respond positively to announcements of increased investment expenditures, even if those investments initially reduce short-term profits.
So the market is essentially saying, we trust that these investments will pay off down the road, and we're willing to reward you for making them.
Exactly. And this is particularly true for investments in research and development, which are often essential for long-term innovation and growth, but might not generate immediate financial returns.
But what about the pressure that companies face from activist investors, who are often accused of having a short-term focus? Doesn't that contradict Jensen's argument?
It's true that some activist investors do have a short-term horizon. They're looking to unlock value quickly, often through financial engineering or cost-cutting measures. But Jensen argues that these investors are actually a minority, and that the market as a whole is much more sophisticated.
So he believes that the market can distinguish between short-term maneuvers that might boost a company's stock price temporarily and genuine long-term value creation that leads to sustained growth and profitability.
That's his central point. And he points to the fact that companies that consistently deliver long-term value are ultimately rewarded by the market, even if they experience occasional setbacks or short-term fluctuations in their stock price.
So Jensen's argument is that while there might be some short-term noise in the market, driven by speculation or short-term trading strategies, the long-term trend is towards rewarding companies that make smart strategic decisions that benefit both shareholders and the broader economy.
Precisely. And this is why he's so optimistic about the role of the market for corporate control. He sees it as a powerful mechanism for ensuring that companies are focused on the long term and that resources are allocated to their most productive uses.
It's a compelling vision, but of course it's not without its critics.
Of course not. Some argue that the market for corporate control is too ruthless, too focused on financial engineering rather than genuine innovation, and that it can have negative consequences for employees, communities, and even the broader economy.
Right. And those are important concerns that deserve careful consideration. But for now, I think we've laid a solid foundation for understanding Jensen's core arguments about the role of debt, the need for shareholder empowerment, the importance of a robust market for corporate control, and the market's ability to distinguish between short-term maneuvers and genuine long-term value creation.
I agree. We've covered a lot of ground in this deep dive, and I think Jensen's work, even though it was written over 3 decades ago, offers valuable insights that are still relevant today.
Absolutely. Now, in our final part, we'll take a step back from Jensen's work and explore how the market for corporate control has evolved since the 1980s.
We'll look at the rise of new players, like private equity firms, the increasing globalization of the market, and the role of technology in shaping the future of corporate takeovers.
Stay tuned, because there's much more to explore in the ever-evolving world of corporate control. Welcome back to the Deep Dive. We've been using Michael Jensen's work as a lens to understand the forces shaping corporate takeovers, particularly during the 1980s. But now let's shift our focus to the present and see how the landscape has evolved. One thing that stands out is the rise of private equity. It's almost like the corporate raiders Jensen described have been replaced by these powerful, institutionalized players.
It's a fascinating evolution. Private equity firms have become a dominant force in the market for corporate control. They pool money from wealthy individuals and institutions, then use that capital to buy and restructure companies, often taking them private. And just like those leveraged buyouts Jensen analyzed, they're not afraid to use debt strategically to achieve their goals.
It's almost like they've taken Jensen's playbook and scaled it up dramatically. These firms can make enormous acquisitions, even of some of the biggest companies in the world, thanks to their access to capital and their willingness to leverage those assets.
That's right, and their approach to using debt can be very effective in driving efficiency. Much like Jensen described, they come in with a clear focus on creating value for their investors, and they're often willing to make tough decisions, streamline operations, and shed underperforming assets to achieve those goals.
Because in a way, they're carrying on the legacy of those 1980s corporate raiders, but with a more sophisticated, data-driven approach. It's less about the flamboyant personalities and more about the financial engineering and operational expertise.
Exactly. They're still shaking things up and forcing companies to become more efficient, but they're doing it with a more institutionalized and less confrontational style. Now, another major shift in the market for corporate control has been globalization. Cross-border acquisitions have become increasingly common, adding another layer of complexity to the game.
That's right. Companies are no longer just competing with domestic rivals. They're also facing the possibility of being acquired by a foreign company. It makes the game even more high stakes and forces management teams to be constantly aware of their global competitive landscape.
It's a whole new ballgame, and this trend has raised some interesting questions about the role of governments in regulating takeovers. Some countries are more open to foreign investment than others, and this can have a significant impact on the dynamics of the market for corporate control.
It's a complex web of geopolitical and economic forces at play. And of course, technology has also played a huge role in shaping the market for corporate control. It's made it easier for buyers and sellers to connect, for investors to gather information, and for deals to be structured and executed more efficiently.
Absolutely. Technology has transformed every aspect of the M&A process. Online platforms and data analytics have made it easier for companies to identify potential targets, conduct due diligence, and assess the financial and strategic implications of a deal.
It's almost like the whole market has become more transparent and accessible thanks to technology. But this increased transparency also brings new challenges. Companies need to be more vigilant about cybersecurity, data privacy, and the potential for market manipulation in this digital age.
Those are valid concerns. And there's also the potential for algorithmic bias to influence deal-making, which could have unintended consequences for competition and innovation.
It's a constant evolution, with technology driving both opportunities and risks. Now, before we wrap up our deep dive, I want to touch on one more trend that Jensen foreshadowed: the increasing importance of shareholder activism. We talked about how institutional investors have become more assertive in recent years, using their ownership stakes to push for changes in corporate strategy and governance.
Right. They're not just passive investors anymore. They're actively engaging with companies, using their voting power to influence board appointments, executive compensation, and major strategic decisions. And they're often working together, forming coalitions to amplify their voices and put pressure on management teams to prioritize shareholder value.
It's a powerful force, and it has definitely contributed to a more dynamic and responsive market. For corporate control, companies know that if they're not performing well, if they're not maximizing shareholder value, they could face pressure not just from potential acquirers, but also from their own investors.
It's a new level of accountability. And while shareholder activism can be a positive force for change, there's also debate about whether it can sometimes lead to short-termism and a focus on immediate gains rather than long-term value creation.
It's a complex issue, and the optimal balance between shareholder activism and long-term strategic thinking is still being debated. But it's clear that shareholder activism is a force that's here to stay.
Absolutely. And it's one that companies need to understand and engage with effectively. So as we wrap up our exploration of corporate takeovers, it's clear that the landscape has changed dramatically since Jensen's seminal work in the 1980s. But his insights about the free cash flow problem, the role of debt, the need for shareholder empowerment, and the importance of a dynamic market for corporate control remain incredibly relevant.
It's a testament to the power of his analysis, that it continues to provide a valuable framework for understanding the forces shaping the corporate world today. And as we move forward, it'll be fascinating to see how the market for corporate control continues to evolve, driven by globalization, technology, and the ongoing interplay between shareholders, managers, and the market itself.
It's a complex and ever-changing landscape, but one that offers both opportunities and challenges for investors, companies, and the global economy as a whole.
This has been a truly insightful deep dive, and we hope you've gained a better understanding of the fascinating world of corporate takeovers. And remember, if you want to explore this topic further, we provided a list of additional resources in the show notes.
Thanks for joining us.